Looking for a stock that's down by more than 40%? Want a market-beating yield and double-digit dividend growth? Like the idea of getting a high-quality stock while it's on sale? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a global leader in mobility technology. Notice record low car inventories. Notice record high car prices. Mobility is becoming a bigger and more important part of everyone's lives, yet supply cannot keep up with demand. That has created a coiled spring for this business. And as that coiled spring uncoils, huge growth in revenue, profit, and the dividend should follow. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explained exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Magna International Inc., which appear to be trading at a significant discount today. Magna International Inc., stock ticker MGA, is a multinational mobility solutions and technology company for automakers that designs, develops, and manufactures automotive systems, assemblies, modules, and components. Founded in 1957, Magna is now an $18 billion by market cap automotive titan that employs more than 150,000 people. Fiscal year 2021 revenue can be broken down by product category. Body exteriors and structures 40%, power and vision 31%, complete vehicles and other 15%, and seating systems 14%. Based out of Canada, Magna is one of the world's largest manufacturers of OEM components for various automakers. It's not just a large company either. There's incredible breadth here. Morningstar puts it this way, and I quote, "Many suppliers focus on a particular area of the vehicle. In sharp contrast, Magna's capabilities are so broad that the firm could nearly design, develop, supply, and assemble vehicles all on its own," unquote. Mobility is becoming more important, and autos are becoming more complex. This situates Magna well, and since more companies are talking about getting into the self-driving and EV space, Magna's breadth sets it up to be a great manufacturing partner. In addition, because of pandemic-induced backups in the global supply chain, there's pent-up demand for new auto supply. Inventories have reached record lows, thus, used car prices have also been breaking records. This has created what appears to be a coiled spring, and as that spring uncoils over the coming years, Magna's tailwind could gust mightily. That should result in increasing revenue, more profit, and bigger dividends for the company and its shareholders. As things stand now, Magna has increased its dividend for 13 consecutive years. The 10-year dividend growth rate is a stout 13.2%. However, I should point out that recent dividend increases have shown deceleration. For instance, the most recent dividend increase was only 4.7%, but I think that has less to do with Magna specifically and more to do with the general situation I just touched on. I suspect that Magna's dividend growth will return to a more normal level when the industry normalizes. While you wait for the growth to pick back up, the stock yields 3%. That's much higher than the broader market's yield. It's also 60 basis points higher than the stock's own 5-year average yield. The payout ratio is at only 36%. Despite the company not necessarily firing on all cylinders, it's still a well-covered dividend. I always like dividend growth stocks in what I refer to as the sweet spot. That's a yield of between 2.5% and 3.5% paired with high single-digit or better dividend growth. This stock is basically dead center on the yield, and the long-term dividend growth rate is well over what I'd usually be looking for. Great dividend metrics. Looking at business growth, Magna has increased its revenue from $30.8 billion in fiscal year 2012 to $36.2 billion in fiscal year 2021. That's a compound annual growth rate of 1.8%. At first glance, this is disappointing. However, it's important to keep in mind that this business has been severely impacted by pandemic-induced lockdowns and the corresponding kinks in the global supply chain. Revenue has still not fully recovered from where it was in fiscal year 2019. Meanwhile, earnings per share moved up from $3.04 to $5 over this time period, which is a compound annual growth rate of 5.7%. Again, I think this result doesn't accurately represent the company's true growth profile. Earnings power has been temporarily but heavily curtailed. If, for instance, we back things up and look at the 5-year period from fiscal year 2012 to fiscal year 2016, EPS supported a compound annual growth rate of over 14%. I expect the company's earnings per share to increase meaningfully as the world starts to fully recover over the next 24 to 36 months. I will quickly add that the excess bottom line growth here has been aided by extensive share buybacks. The outstanding share count is down by an enormous 36% over this 10-year time frame. Looking forward, CFRA believes that Magna will compound its earnings per share at an annual rate of 25% over the next 3 years. I just stated that I expect a meaningful increase in the company's EPS over the next few years. Well, that is meaningful. I would ordinarily scoff at this kind of eye-popping growth forecast. However, this is not an ordinary situation. I see Magna's business as a coiled spring. They've been forced to operate at subpar levels for 2 years now. As the supply chain kinks start to unwind, the coiled spring should explosively uncoil. Record low inventories for new autos are coming at a time when demand is at all-time highs, leading to very high prices. Supply doesn't have to just catch up to 2022's demand, but also make up for the losses over the course of 2 years. There's a huge gap to fill. There's simply not enough supply to meet demand. CFRA states it best here, and I quote, "Sales would be stronger if not for the record low inventory levels and parts shortages, particularly in semiconductors, which have plagued the market in recent months, and we expect to persist well into 2022 and possibly beyond. In 2020, U.S. light vehicle sales posted their weakest total since coming in at 14.44 million units in 2012, unquote. However, that simply creates a need for a catch-up in supply. The compression has to uncompress. CFRA adds this, and I quote, "On the positive side, strong consumer fundamentals, economic growth, low unemployment rates, and relatively low but rising interest rates should help support sales volumes. We think margins will benefit from a combination of record high new vehicle price realizations, now over $47,000 in the US, and cost cuts implemented during the course of the COVID-19 pandemic," unquote. Now, Magna does have some idiosyncratic challenges, including 6 idled plants in Russia. Overall, however, I think Magna could be entering into one of the best stretches the company's ever seen. With a low payout ratio and the projection for near-term double-digit EPS growth, dividend growth should be outstanding. Pairing that with a 3% yield offers a very nice combination of yield and growth. Moving over to the balance sheet, the company has a solid financial position. The long-term debt-to-equity ratio is 0.3, while the interest coverage ratio is at 17. The latter number is already very good, but it'll get even better when EBIT rises. Furthermore, there's a healthy cash balance, almost enough to pay off all long-term debt in one fell swoop. Profitability is fine, and I think it'll improve quite a bit over the coming years. Over the last 5 years, the firm has averaged annual net margin of 4.5% and annual return on equity of 16.3%. Magna is a great business with recent headwinds poised to transform into powerful tailwinds, and the company does benefit from durable competitive advantages, including economies of scale, barriers to entry, and switching costs. Of course, there are risks to consider. Competition, regulation, and litigation are omnipresent risks in every industry. The company does have exposure to Russia, and they've had to idle 6 plants over there. Input costs are volatile. Customer concentration risk is present. Magna's 6 largest customers account for nearly 80% of the company's annual sales. Magna has direct exposure to economic cycles. This risk is amplified by the fact that the company runs a capital-intensive business model. The global supply chain is still in disarray. This could drag on longer than expected. There's risk around technology. Technological changes in mobility could happen in a way or at a speed that Magna is unable to adapt to. It's certainly valid to be concerned about the risks, but I still think long-term dividend growth investors have a great case for buying shares in the business. That investment case has been made even stronger by the stock's 41% drop from its 52-week high, which has created an attractive valuation. The stock is trading hands for a price-earnings ratio of 12.3. That's well below the broader market's earnings multiple. It's also measurably off of the stock's own 5-year average PE ratio of 13.8. Plus, the E and the PE ratio here is temporarily depressed, making this ratio even lower than it appears to be. And the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7.5%. This dividend growth rate looks awfully conservative when we consider the company's own demonstrated dividend growth rate over the last decade. The payout ratio is low, and the near-term EPS growth forecast is well into the double digits. However, Magna's 10-year EPS growth rate is lower than this mark, and there's still a lot of global uncertainty. Overall, I think Magna will exceed this mark over the long run. I'm being fairly cautious here, but I'd rather err on the side of caution. The dividend discount model analysis gives me a fair value of $77.40. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Magna as a 4-star stock with a fair value estimate of $81. CFRA rates Magna as a 4-star buy with a 12-month target price of $90. I came out a bit low this time around. Averaging the three numbers out gives us a final valuation of $82.80, which would indicate the stock is possibly 34% undervalued. Here's the bottom line, guys. Magna International Inc. is a world-class supplier and manufacturer in the mobility space. Record low inventories and record high prices across autos has Magna's business looking like a coiled spring ready to explosively uncoil to the upside. With a market-beating yield, double-digit dividend growth, a low payout ratio, 13 consecutive years of dividend increases, and the potential that shares are 34% undervalued, long-term dividend growth investors should strongly consider adding this stock to their portfolios. And now for a special news announcement. JPMorgan Chase & Co., stock ticker JPM, just announced their first quarter earnings. I'll be honest, it wasn't an excellent quarter. A bit cautious, a bit messy. But here's the big headline. JPMorgan Chase announced a new $30 billion buyback program. That's roughly 8% of the company's entire market cap. We just put out a full analysis and valuation video on the bank showing why the business could be worth more than $156 a share. JPMorgan Chase will be buying its own stock hand over fist. You should think about doing the same. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.